think now there was a wake up call. It's like a lot of people were kind of complacent, and I think when it's considered low risk, they don't really chase. The bank deposits have historically been pretty sticky. You don't shop around for a new bank just to get a couple extra basis points here or there. But when people are actually concerned with their risk, suddenly they pay a lot more attention. And when you see that it's that, to the prior point about both higher yielding and lower risk, if they make certain choices to move, then they do it. And so we're still seeing very rapid inflows to money markets. And so all of that is pressuring the liquidity profiles of banks. And something that Caitlyn's pointed out before is that as money moves faster, if anything, banks need more liquidity. But one of the Fed's tools in this environment is they're trying to constrain lending by pulling liquidity out.
Both Lyn Alden and Cathie Wood are regarded as authorities in their respective fields of finance and investing. Lyn Alden is well respected in the fields of macroeconomics and investment strategy for her data-driven insights and in-depth analyses of international markets. She established Lyn Alden Investment Strategy and is a published author. Cathie Wood, on the other hand, is the head of ARK Invest, an investment management firm that specializes in cutting-edge innovations and paradigm shifts. She has become one of the most successful and influential investors in the world thanks to her risky and original approaches to the market. According to Lyn Alden, the need for stricter capital controls and a slower rate of capital flow is being driven by geopolitical concerns. Meanwhile, Cathie Wood raises concerns about the state of American competitiveness and innovation, noting that banks made significant mistakes in their assumptions about interest rates. Both parties acknowledge the need for the United States to update its regulatory framework for digital assets to account for new uses. Lyn Alden discusses Bitcoin's reaction to the financial crisis and predicts that, soon, everyone will be vying for their own Bitcoin pie.
Increased capital controls and increased kind of national security interest in preventing the easy flow of capital across borders and things like that. And as we see geopolitics obviously heat up, we see the unipolar world we've been in for the past 30 years kind of divide into two or more poles in the world. There's obviously a lot more focus on blocking those borders. And so I think that's kind of one way to look at it from a strategic perspective. And when you look back also at periods of time where large developed countries have very, very high debt burdens, they're often stuck in a position where they're running large fiscal deficits, they have very large debts. If they have positive real interest rates, then they have trouble servicing those debts over the long course. And so a lot of capital flight wants to go out into harder assets, and then they end up trying to slow that flow in various ways. So I think that's one kind of like very long-term macro strategic thing to be aware of. And then of course you have on top of that the more securities investor protection focused thing, which I think it's obviously overlapping in many ways, but it is somewhat of a different focus. I mean, the same invention that allows for peer-to-peer money now kind of allows for peer-to-peer securities in a way. And so, it used to be that, to launch something like a security, it was an expensive process. And now the technology makes it easier, and it's kind of butting up against those existing securities laws. And so it reopens questions like, what is a security? How can we protect investors while maybe streamlining the process and updating, realizing that technology is different now. Things can come to market faster. Things are more automated, less overhead. So I kind of put this whole thing into almost two separate buckets, even though they do obviously have some degree of overlap in the middle.
The banks made two major mistakes in their assumptions, and both of them actually are very understandable because these two assumptions proved wrong because they had either never happened or never happened in our lifetimes. So one of them was during COVID, as the Fed and everybody else was worried about depression. You look at the Fed's forecast in that year of 2020, they had interest rates short-term interest rates at 0.2 through the end of this year, which is where their forecasts ended. So you've got these banks like Silicon Valley and others who say, okay, I'll put my money into government-backed long-term instruments, very safe, maybe too much held to maturity in the case of Silicon Valley Bank, but very safe, right? 1.6, 1.7% yield. And then the Fed raises interest rates 20-fold in 1 year, which has never happened. Never, never, never happened. Volcker was twofold, 10 to 20%. And many people brushed off, our concern about this because, it's such a low base. That's exactly the point. It's been such a low base for so long that nobody expected this. So that was the first mistaken assumption. And even that would have been okay as long as the deposits had kept flowing in, which of course they didn't. We had the venture capital funding drought. That's why Silicon Valley's deposits started departing. And others were just looking for higher yields and money market funds. And if you look at many people think the large banks have been immune from this. They have not. Their deposits are falling as well. And it is because of this search for yield and safety. I mean, the most damning thing I've heard during the past few weeks from a number of people who said, well, yeah, I lowered my risk by taking my deposits out and increased my return by putting them into money market. That's not how this works, lowering your risk and increasing your return. So I think that's how it started. I think the Fed has, has made a lot of mistakes. And I think the reason is it does not respect market signals. Doesn't respect credit default swaps going up, so bets on bankruptcy, doesn't respect inverted yield curves, doesn't respect commodity prices going down. There are a lot, and is the first Fed ever to raise interest rates in a crisis, and now they're thinking about doing it again.
I think one of the challenges is like if we look at one bank, we get one opinion, but if we look at the banking system as a whole, we get another opinion. So any individual bank could have managed this better than, for example, some of the really problematic banks handled it. They chose long duration, they chose a riskier deposit base, basically very business oriented, very industry specific. They set up two risks on the same balance sheet, which were catastrophic. But when you look at the banking system as a whole, someone has to own those securities, and they have to own them with these funding costs, kind of the way we set up the system as it currently is. And so the sheer level of activism from the Fed is just an extremely hard environment for those banks to operate under. Ironically, if they had shorter duration but higher credit risk instruments, they held up better than if they had long duration risk-free assets in this environment, which is normally not how it works. And back in like late 2021, the Fed, inflation was way above target, and the Fed was still doing QE. They basically were slow to be hawkish, but then when they finally turned hawkish, now suddenly they pull liquidity out of the banking system at a record pace, while to Cathie's point, increasing interest rates at it's in a year-over-year basis is the highest absolute term since the 70s, but on a percentage basis from such a low base, it's the highest ever. And the banking system's not really designed to be able to withstand that type of turbulence. And if you look at the Federal Reserve itself, it's operating at a loss because part of its way of managing interest rates is it increases the rates on its own liabilities. And as the Federal Reserve, it's able to do that because it doesn't need to be profitable, doesn't need to, it's not exposed to bank runs. But if you were to just take the average bank now and put their deposit rates where money markets are, they'd almost all be unprofitable, and therefore they'd be losing capital from and they'd be unable to raise capital. And so on one hand, if the Fed's saying, okay, all banks have to do what we did, well, then you just destroyed the entire banking system. And in the past prior few raising cycles, you saw T-bills go up in rates, you saw money markets go up in rates, and deposit rates didn't really follow because these were pretty brief changes, and eventually those rates would come back down before people really adjusted to those new rates. But if they do try to target a higher for longer environment, and in a world where information flows around faster, the ways of moving money are faster, banks are kind of stuck having to raise their rates to try to keep up with this. And then the end game scenario is if they actually get up to where the Fed is on rates, if they get up to where money markets and T-bills are, they're practically all unprofitable and then heading towards insolvency. So kind of like, I think the Fed is just in some ways not understanding the gravity of the situation. and it's both on the upside and the downside. So they were overly aggressive on things like QE, longer than they needed to do it. Probably the bigger story is we have to think globally. I mean, when we describe what the global financial system looks like, it's like, there's 180 currencies roughly. A lot of them are pegged to the dollar or other things, but there's all these like currencies, and they're all these like local monopolies in their own jurisdiction. So all of the cross-border trade is very high friction, and you see a lot of people around the world, especially because most of these currencies don't hold up as well as the dollar, as well as the euro, as well as some of these others. And so there's a ton of interest in Bitcoin, tons of interest in stable coins. Basically, all the different, they gravitate towards these monies, these harder monies, and of course, obviously, there's different time frames. I mean, Bitcoin is very volatile, but it's been attractive for long-term holders. Stable coins have been very popular in these very high inflation countries because they still might lose value slowly, but it's less quickly than what's happening with their own currencies. And so you see in Argentina, Lebanon, Turkey, all these different countries, they pour into these types of assets. And so I think when it comes to a lot of people in the world, it doesn't, it's more obvious to them. And I think in the West broadly, we've been very complacent with the operation of our financial system. A lot of people don't see why they might need these technologies, but I think that over time it's become more and more clear as we've had a pretty high inflation spike and now we've had banking instability. I do think more and more people are looking into this and saying, maybe this Bitcoin thing isn't crazy. Maybe it's worth having a slice. I still think advisors are very underallocated. But we are starting to see reports that even though their clients are going to them and saying, when are you going to make it possible to have a Bitcoin slice? I want to hold some Bitcoin. So I think probably the next cycle will be pretty big for advisors. I think an ETF would be helpful in that regard. That's obviously been slow. We're starting to see brokers offer more direct Bitcoin exposure. But something like an ETF, a spot ETF is I think it's been proven in other countries that it's fine. And so I do think that there's still a lot of, obvious low-hanging fruit for pools of capital that are either no exposure or very minimal exposure to go from zero to some.
Do you agree with Cathie Wood and Lyn Alden's assessment of the economy? Leave a comment and let us know what you think. Thank you for watching today's video on Market Empire. If you found this information helpful, please don't forget to like and subscribe to our channel for more insightful content on finance and investing.